You're listening to the Financial Source podcast on YouTube.
If you just glance at the global financial markets today, you might actually be tricked into thinking it's a quiet day.
Yeah, the headlines aren't exactly screaming about a stock market crash or anything.
Right, and major currencies are basically flat. But if you look closer, specifically at commodities, well, something really doesn't add up. We are seeing these historic, almost crisis-level moves happening right alongside a market that is supposedly, just trading cautiously.
It creates this incredibly tense atmosphere. I mean, on the surface, investors are holding their breath, waiting for the next shoe to drop. But underneath...
With one of the trade wars and geopolitical anxiety.
Exactly. Underneath all of that, the pressure is really building. So our mission for this deep dive into the latest financial market report is to figure out if this is just a pause before a rally or the silence before a storm.
And the absolute centerpiece of all this tension for you to keep an eye on is the U.S. dollar. The DXY index is up modestly, about 0.1%. But it's not because the economy is suddenly booming. It's moving entirely on friction.
Trade friction, specifically. We're seeing reports that Donald Trump is doubling down on national security tariffs.
Which is completely distinct from that 15% global flat-rate tariff proposal we unpacked for you last time.
Right, this is a clear escalation. The report highlights a specific threat to increased levies on countries that challenge recent Supreme Court rulings.
It's effectively weaponizing trade policy to settle legal or political scores.
Which naturally triggered a very fast response. The European Union really didn't hesitate here. They're already warning that this framework breaches existing agreements.
They've even put the ratification of a bilateral deal completely on ice.
So we have a genuine standoff, yet the markets are restrained. And that's largely because everyone is just waiting for the president's State of the Union address.
The classic wait-and-see factor. The market is hoping for some cost-lowering measures to be announced in the address, which is kind of keeping a lid on the panic for now.
Meanwhile, the currency markets are definitely reflecting that hesitation. The euro is essentially dead in the water right now, stuck under the 1.1800 level.
Yeah, ECB President Christine Lagarde is out there telling everyone that inflation and policy are completely stable, so there's just no catalyst for movement there.
But Asia is a totally different story. The move in the USD to JPY pair, reclaiming the 155.400 level, was fascinating.
Because that wasn't just market noise.
No, that was the People's Bank of China stepping in. They set the daily reference rate for the yuan, the fix, much lower than expected.
They effectively gave the market permission to sell off the yuan.
Which triggers a massive domino effect. A weaker yuan drags down regional currencies and makes the US dollar look like the only safe giant in the room.
Pushing the yen down with it. And just to briefly round out the currencies, the pound is hovering right near 1.3500, and the Aussie and Kiwi dollars are up about 0.2%. Thanks to higher metal prices.
And speaking of metals, while currencies are playing 4D chess, commodities are just screaming.
This is where the narrative of a quiet market completely falls apart for you. We actually saw gold briefly top $5,200 per ounce.
That is a staggering number. $5,200 is completely uncharted territory.
Even though it retreated 1.1% later in the session, and silver fell 3%, hitting that high suggests someone, somewhere, is terrified.
But here is the major contradiction. While gold, the ultimate fear index, is hitting historic highs, copper actually gained 1.3%.
Dr. Copper. It predicts industrial health. It really only goes up when major buyers are stepping back into the market and planning to build things.
So you have one asset pricing in the end of the world and another pricing in an industrial boom. It's a massive divergence.
And if that wasn't confusing enough, we have to talk about the bond market. U.S. Treasury futures pulled back as demand cooled.
Which is normal ahead of heavy economic data releases.
Right, but the report noted something super curious from the previous session. Bonds actually climbed partly due to fears of artificial intelligence-related disruptions.
This is a wild new one entering the risk lexicon. Traders aren't just worried about inflation or interest rates anymore.
Now they're pricing in the risk that AI disruptions could destabilize the financial plumbing. Whether that's massive power grid failures from energy demand or algorithmic trading flashes.
It's crazy to think tech risk has moved from stock prices to the actual stability of government bonds.
So to recap the board for you today, the dollar is grinding higher on tariff threats, the euro is totally asleep, and commodities are wildly split between panic and greed.
It's a holding pattern, but a very fragile one. The market is trying to balance those immediate political risks against the upcoming heavy slate of economic data.
Which leaves us with a final thought for you to mull over. We have gold hitting $5,200, signaling a crisis, We have copper rallying, signaling an industrial boom, and we have bond traders worrying about AI taking down the grid. The market is usually a voting machine, but right now the votes are completely split. Is the market positioning for a catastrophe or a renaissance? Or is the uncertainty just confusing the signals entirely? We'll be watching closely to see which one wins out tomorrow.